I'm going to figure it out. So yes, Reliq Health Technologies Inc., RHT on the TSX Venture, currently trading at a price of around 48 cents and has about a $96 million market cap. So Reliq Health is a telemedicine provider that develops virtual care solutions for the healthcare market. It offers its iUgo Care platform, a software as a solution service that allows patients to receive care in the home. So we have reviewed Reliq a few times on the podcast now, once in 2018 as a dog when the stock was down 85% over the course of that year, as the company was putting up severe losses on some of the contracts that it had recently secured. And keep in mind, at that time, the business was completely contract driven. But beginning in 2021, once the company switched from primarily a hardware business to a software as a service model, the company began winning contract after contract and has posted consistent revenue growth quarter over quarter and even dipped into profitability in Q3 of 2023, which is the most recent quarter. Right now, placing Reliq with a trailing price to sales multiple of about 6.4 times, which is much better than the last 15 times trailing multiple that it traded with about 12 months ago when I covered the stock last. So looking at the positive earnings the company has generated in the last quarter, the income statement really is quite clean, and there is really nothing out of the ordinary which is boosting profit other than some interest income. But if we look at each line item more granularly compared to last year, gross profit margin was up to about 67% from 65%, while advertising and research and development expenses were down substantially. And this is the primary reason for breaking into some net profit here. However, the balance sheet is into a slight net debt position when we include leases, but their receivables are up there at about 12.4 million, which is traditional with some of these healthcare companies having the larger receivables. Now, if we look at the company's share count over the years, clearly we can see that Reliq has been funding primarily through share dilution, where it's now up to about 200 million shares outstanding. So given the large outstanding share balance, Reliq would need to generate about 2 million in profit to generate 1 cent in earnings. And let's just say hypothetically, the company can get to that each quarter. The business would still trade at about 9 times forward earnings. But again, considering they generated less than half a cent in the last quarter, and it's their first quarter of GAAP profitability, they still have a lot of proving to do. So moving on to some management comments and updates here. The company anticipates growth to accelerate into 2024 and does not expect to need to raise capital or take on debt to fund future operations. So hopefully for current shareholders, we see the dilution stop and for the business to fund through internally generated cash flow. Now, Q4 2023 results will be out by October 28th of 2023, and management said that at that time, they will begin providing forward guidance. So we have that to look forward to. Now, they also deployed artificial intelligence and machine learning with 2 clients. They essentially kind of did a beta test to identify at-risk patients. So that's what their software is doing. And they expect to potentially license to third parties in 2024. And as well, the company expanded to Mexico with its first client, and they also signed some large contracts in the year in the US. So to conclude, last time I concluded by saying that the company continues to lose money, but that it does appear to be on a better track to potentially break into profitability. But of course, the internet lit me up as they always do because I wasn't positive enough on the stock. Now, this time, I have to double down on my statements. Reliq is an interesting business that has had tremendous growth and now has broken into profitability. But I think that it will be crucial to ensure the business can maintain this profitability and confirm that it does not have to raise capital to fund operations like management has said. And last but not least, see what the company is guiding toward for the fiscal year the 2024 fiscal year when they come out with their Q4 earnings in October. So it's interesting. They've broken into profitability. I think it would be really interesting to see if they actually don't have to, dilute or take on more debt and, what they're guiding towards for the 2024 fiscal year. And that's it. That's all.
Yeah. One thing I find interesting is that, the talk of expanding to Mexico with its first client when I don't know the nature of that expansion, if that's seen as like a geographic expansion, but I mean, there must be so much space to expand just within the US healthcare system. I
Yeah.
mean, they're so small. It's so to them so unsaturated. So why would they start with a geographic expansion at this point, without being fully profitable and fully, more, capturing more market share in the US? Just as a thought.
Yep.
Sometimes that can be seen as a red flag if companies are really quick to expand geographically before they've really gotten any serious foothold in their core market.
Mhm.
It's potentially a sign that they're having trouble selling in their core market, but that may not be the case. It's just something that I noted.
Yep.
Yeah, and when was do you have it right there when the last time you reviewed it
I
on
think
the
it was about
podcast?
11 or 12 months ago. So it's almost a full year, I believe.
So it's basically flat to slightly down over that period.
Exactly. Yeah,
And the
exactly.
question is, would you buy it here? And you're looking for them to prove out profitability. They've stepped
Exactly.
into profitability, but just on a quarterly basis, it's good if we can forecast that going forward. But even at the rate they produced in their last quarter, it's not expressively cheap.
No.
Even if they continue to earn. And what was it? A quarter of a cent? Did you say? Did they?
It was, yeah, about a quarter of a cent, or I guess, yeah, quarter of a cent. It was
It's
like
almost
point
half
zero
a
zero
cent, wasn't
four,
it?
or almost
Or
half a
I
cent.
mean,
Sorry.
is it
Yeah,
half a
it
cent?
was
So
almost half a
if
cent,
if
but
they
it's still
had
under
two,
half.
they'd be trading at 25 times earnings or something like
Yeah.
that. In that, even if you could forecast them doing that and extrapolate going forward, now that would look better, but it's still not expressively cheap. When there are companies that we can find out there that are trading at 15 times earnings and growing well beyond that, or they're trading at 10 times earnings and growing well beyond that, have a better balance sheet and a higher history of profitability. So I mean, for us, the bar is quite high to leap over.
Yeah.
Good to see what they did in their last quarter in terms of Reliq. That's what we're talking about. But can they continue it going forward? That's what we'll continue to monitor.
Yeah, exactly. The trajectory looks good, but again, they still have some proving to do, and I know
Yeah.
that the internet's going to rip me apart on that.
And
But that's all right.
there
You
may be a
got ripped
scenario
apart
here.
last time you talked about Relic.
Yes, yeah, they were.
You
There
know
were
that
some
half those
comments.
comments are just me for my troll accounts, right?
Probably,
Yeah,
probably.
just ripping you.
There were some
No, I
comments.
mean,
Or go on, Ryan. Go on.
sorry, I would say that this company may, funding through equity releases. We've seen this story before. They may at some point have a rollback in terms of the shares to, have the share price boost and to be able to have more meaningful EPS. It may be a benefit to this company to do that over the long term to get their capital structure in order. And you may see that at some point. They may have aspirations of going on to the TSX or going on to the NASDAQ. At some point, you'd likely have to see that because even though the trajectory of growth is good, to get meaningful per share cash flow EPS, they may have to roll back those shares at some point, and you may see something like that, and it may actually be a benefit. Often, you're seeing a rollback because of a terrible situation at a company. For a business like this, you may see it, and it may benefit the company over the long term. It may be some short term pain, but for long term gain of getting that capital structure in order and looking better, so you can actually have that meaningful per share cash flow and per share earnings.